Yes. So, hi everyone. Good evening. So, welcome to the session of Jargon Buster series. So, this is the ninth session that we are having in this series now. So, today's topic is actually an interesting topic, a bit general, a bit wide topic, but not much technical though. So, unlike the previous sessions, what we had, it was a bit more technical. So, this session is more going to be a general topic and give you an idea about what actually investor readiness means and why is it important to stay investor ready if you are a startup or an SME who are planning to raise funds. Even if you're planning to raise funds or even if you're not raising funds also, the term investor readiness is very important for any business. Okay. So the core agenda of today's session would be first thing like to understand what it means to be investor ready. Then what are the core pillars of investment readiness? Then the key area like wherein we typically face a lot of issues is the so due diligence and organized data rooms. What are they? What is why we need to have continuous practice and hygiene? What is the role of professionals in keeping your company investor ready? How to reduce the fundraising time or how investor readiness help you reduce the fundraising time? And what are the steps and key takeaways? So this is how today's session is planned, and this is the flow that we are going to follow. So I'm diving straight into the definition and all those things now. So primarily, what is investor ready? So that is a key question that everybody has. So investor readiness, if you ask me, like it's actually the overall preparedness for a startup or a company to attract investment. Okay. So you should be having all the critical elements for the business, which typically an investor would be evaluating. For example, a viable business model, like a clear growth potential. Then the investor should be able to make return if he invests in your company. And on top of that, whether your compliances, whether your books are proper, is there any risk that the investor is going to face if they invest in your business because there is some license or something pending? So all these things comes under investor readiness. Okay. So being investor ready is that okay, today if some investor comes and they want to put money into your business, they should be able to do it in in a very uh, time. So that is what if you ask me, be investor ready means. Okay. And why it matters is readiness signals to investors that you are serious and organized. Primary thing is that if your books are clean, if you are investor ready, you have a proper data room, your compliances are up to date, your financials are submitted to the MCA, you have all the numbers that the investors are asking, which means that the investor is going to treat you as a serious guy, and also they'll feel that you are organized. In fact, you will be organized. Okay. So the investor, the readiness actually signals to the investor that you are serious and organized, and without it, even innovative ideas struggle to gain back. You have a superb business idea, it's going to scale in high potential, but you're are very poor. You're not really worried about the compliances. You're not worried about the cash flow. There is no proper number or anything what the investor is asking. You would struggle to raise funds. Okay. And also investor readiness actually increases the speed of fundraising and also the likelihood of funding. Why? Because, for example, if your company is not investor ready, the possibility of you raising the funds would be say around like what 30-40%. But you are investor ready, you can up to like 60-70%. Again, like there could be another 20-30% of contingency, but it can actually do a lot of miracle. And how it increases the speed is because whenever the investor asks you some data, you can give it in no time. When there is a due diligence happening in the company, the team who is doing the DD, they can review all your data in no time. So that is going to reduce a lot of time in your business. So that is why investor readiness is important. Okay, why investor readiness matters? So I've noted down few reasons and what are the benefits that we are going to get from investor readiness. Primary thing is prepared for opportunities. So don't miss unexpected calls, seize deals quickly. So why you need to be prepared is because see every time an investor in most of the cases you would be outreaching an investor. Okay, but there are high chances that for example a PR article about your company or something what you have done gets released in a media. There can be a chance that an investor can approach you and ask if you are interested in taking an investment from him or onboarding him as an investor. So in those cases, maybe you may not be prepared to take the investor, but you are sure that in next 2 to 3 months you are planning to raise funds. In such a situation, you should be prepared. So if you're investor ready means that you can tell the investor that let me have a meeting with my co-founder and get back to you very shortly. And in fact, you can have a discussion internally and get back in no time. So you won't be missing any unexpected calls, and you can also seize the deals quickly, which means that and also the thing with funding is that when you have investors coming in, that is a time when you actually should be raising, because fundraising takes a lot of time. You have to reach out to a lot of investors for raising funds. So whenever there is an investor ready, that is a time you should be getting that investment into your company. So you should not be missing such opportunities. Then transparent reporting and governance improves operational performance and instills trust. So when you have proper documents in place, when you have proper compliance in place, when your returns are filed properly, you are doing everything within the due date, and everything is crystal clear, everything matches with what you are submitting to the government. In that case, it increases a lot of transparency. As a founder, when you're speaking to an investor, you'll have a lot of clarity on the numbers and what is happening in your business. That will actually give a lot of trust to the investor. The investor typically at early stage, they evaluate the founders, how capable the founders are. And when you start speaking with so much clarity, that actually brings a lot of trust to the investor, and the investor would be confident enough to put money into your business. So, and also when you're tracking these numbers properly, what happens is you can understand where your business is currently. Not only an investor, you'll be able to convey it to an investor, you yourself will be able to understand what is happening in your business. Okay. The next thing is strategic clarity. Facilitate board and investor conversations. So, again, what I've told in the earlier point, when you have all the numbers and all the data in place, you'll be having more clarity on what is happening in your business. That would actually help you take strategic decisions, give the investors with numbers, or maybe help you to evaluate whether your business is moving in the right direction, whether your pricing strategy is right or wrong, whether you need to do a tweak in the pricing. All those things you will be having more clarity. Then the next one is time kills deals. Poor governance, weak reporting, and compliance issues derail transactions. This is what I have told in the previous slide also. So see, typically if an investor asks you to send some data, like they are interested in your business, you had the first round of call with the investor, and the investor is quite impressed with what you're doing, and they have asked you for a set of data, like they need your last 12 months MIS, they need your audited financials, and they need your pitch deck, but you have nothing ready, or maybe if your pitch deck needs some updation, but MIS you don't have it, your last year audited is not pending, is still pending. uh, Maybe if you convey this to the investor would be telling you, okay, you get all these things in place and get back to me. Okay, by the time you sort all these things and go back to the investor after 2 months, the investor may not be interested in the deal anymore, because that actually gives a kind of red flag to the investor, or it actually demotivates the interest of the investor also. And moreover, uh, you feel that you are not adhering to the compliances, you are delaying a lot of compliances, which in turn may cause you a lot of penalties and all those things. So when the investor is putting money into the business, what they typically expect is that you would be using the money for growing the business. But if your governance is poor, or your compliances are not on track, the money that the investor put in may go to pay off these penalties and interest. So the investor won't be making any money out of or any return out of what they have invested. So that is another important point. So time kills deals, like poor governance, weak reporting, and compliance issues derail transactions. So again, just going through the reasons, like you will be prepared for opportunities, transparent reporting and governance, strategic clarity, and time kill. Okay, now core pillars of investor readiness. So first thing is the business foundation. Like you should be having a clear plan, clear legal structure. Your cap table should be clean. if you are into a technology space or like kind of you are using a brand name or something, you should have the relevant trademarks, patents, and all those IPs protected. So your business foundation should be like kind of very strong. Okay, that is the primary structure, and you should be a private limited company. Obviously, if you're raising funds, you should be a private limited company. So all these things should be there. So business foundation is a core pillar of investor readiness. Then team and advisors, credible leadership with domain expertise and commitment. So your team should be like kind of really solid. Uh, the founders must have like kind of credible, uh, I mean, records like maybe like your prior experiences, what you have been doing previously, what is your overall experience, and also like kind of the advisors whom you are having. Like if you are having somebody from a who is a non-figure in the business and he's advising your company, that definitely would be bringing more value to your credibility, more value to your team. Okay, so credible leadership with domain expertise and commitment. Then the next one is market and traction. So validated demand, unique value proposition, and KPIs. So the next thing is like kind of the market in which you are operating should be actually like kind of having a lot of demand, and like kind of the product should be, or the product or service or whatever you're building, that should be able to scale within that market. So that is another important thing. So you should be able to, you should be understanding the market, and like you should be in a market, or you should choose a market where there is actually a demand. Okay, so validated demand, and what is going to be your unique value proposition, like how you are going to be separate from your customers, or sorry, separate from your competitors. So those things you need to like kind of again uh, showcase to the investors. So that is again another core pillar. Then the KPIs. When I say KPIs, key performance indicators. So those are like kind of numbers associated to your business. For example, it can be the number of customers growing, or like kind of average revenue per customer, or the overall revenue that you have achieved in the financial year. All those things can be KPIs. So again, these things also should be like kind of tracked, and like kind of you should be able to show that traction also. You are in a good market and you have like kind of started scaling, or you have started progressing in a right direction, that you should be able to show. Then financials, accurate statements, realistic projections, and gap compliant reporting. So when I say your financials should be like kind of accurate, it should be 100% transparent. All the entries must be accounted, like minimal or in fact no cash transactions, complete through bank, and all the expense head and everything is mapped properly in the right head. There is no duplication of expense head and all. Then the projections that you are having, or that the projections that you're building, that should be realistic. Okay, so that's what I've seen typically with a lot of early stage startups or like kind of SMEs, is that see, projections need, it can be ambitious. Obviously, it can be ambitious, but it should be achievable also. Another third party, or another third party person who is reviewing your projection should feel that this is achievable. For you, it is an ambitious thing. But if you're looking at, so for example, if I'm an investor, or somebody is coming to me with a company which is 3 years old, and for the next 5 years project, within the 3 years, their revenue that they have already cracked is somewhere around 50 lakhs only. But they are telling that in the next 5 years, they are going to reach 1,000 crore. So obviously, the doubt or the question that I would be having in my mind is, see, in 3 years, he was only able to do only this much, 50 lakhs of revenue. And this person is telling me that in next 5 years, he'll scale it up to 1,000 crores. So how is that even going to be possible? So when you build the projection, it should be a bit more realistic, or like kind of with the fund that you're going to raise. For example, and also the ask of the fund. You cannot simply ask the investor for a 100 crore as your first fundraise ask. You should be like kind of asking the funds in a like kind of progressive manner with milestones and everything. Then the next thing is gap compliant reporting. So gap is generally accepted accounting principles. So in whichever country you are in, there will be accounting standards and principles for that particular country. So the books should be drafted in such a manner, which is typically what your chartered accountant or your accountant does. So financials is another core pillar of investor readiness. Then the narrative and pitch. So compelling story backed by data and an organized data room. So your pitch, you should be having a pitch deck, and that even though if you are not having a pitch deck also, pitch deck is important, but still if you are not having a pitch deck also, the narration that you're going to give, the story that you're going to present before the investor should be very compelling, and like kind of it should be data oriented. Like it shouldn't be like kind of an ambitious story or anything. It should be like kind of backed by facts and like kind of your experiences or whatever traction you have built across the period. These things should be reflecting, and this would actually increase the investor confidence a lot. And again, the next thing is an organized data room. So if you have every data properly in place, uh, it actually like kind of helps you to send the investor the required information as and when they need it. Okay, so an organized data room is another thing. So again, going back to core pillars of investor readiness, business foundation, like I've told, like your legal structure, clear plan, IP, cap table, all those things. Then team and advisors, credible leadership team with domain expertise and commitment. Then market and traction, like you should be in a market where there is actual demand, and how you are different from your competitors. You should be tracking your KPIs and all those things. And this KPI should be like kind of in a progressive uh, way also, like kind of that shows the traction that your business is having. Then the financials, it should be accurate. It should, the projection should be realistic. Your financials should be cap compliant. Then the narrative and the pitch. Okay. So next thing is due diligence and data room. So it's actually an interesting topic for me. DD is something what I do a lot for on behalf of investors and on behalf of companies who acquire smaller companies. So if you ask me what DD is, DD is actually kind of a verification by an independent like kind of consultant. It can be a chartered accountant, it can be a lawyer or somebody like kind of who is qualified. They actually reviews all your financials, your company records and everything, and ensure that this company is investor ready, or like kind of the company is having all the data in place and it's a compliant company. Okay. So and the data room is something what the investor typically ask, or the consultant who is doing the DD typically ask the people or the startup to give what all data you have for them to verify. Okay, so for me to do a DD, I need to have the financials of the company that I am doing the DD. I need to have the agreements. I need to have the incorporation certificate. I need to see the projections. I need to see the GST registration certificate. I need to see the GST returns, GST worksheet, and all those things. So I need all these things. So when you organize these things properly in a folder, that is called a data row. Okay, so this can be virtual or it can be physical. Virtual the better, because in currently like nobody is following the physical format, because nobody would be coming and sitting in your office and reviewing your files. So everybody would be preferring to have it online. So it simply can be a Google Drive folder or a SharePoint folder, wherein all your data are organized in a neat and proper manner. So what I'll just take you glance through what are the categories and key documents. So first thing is financials. So there can be a folder named financials where you can show all your historical statements, projections, assumptions, and everything. Then there can be a folder for legal, where you can keep all your incorporation certificates, incorporation related documents, shareholder agreements, MOA, AOA, licenses, and all the agreements. Then you have contracts where you can keep the customer and vendor contracts and also employee agreements. Then a folder can be cap table and equity. How is your cap table currently looking like? What is the valuation that you've done? You can keep your valuation report also in this folder. Then you can have a folder for intellectual property, your patent, your trademark, and all those things you can keep in this folder. Then your team, your organization chart, who are your key employees, their resumes, their job description, what is your hiring plan, all those things you can keep in this folder. Then strategy, the market research, competitive analysis, product roadmap, all these things you can keep in that folder. So these basically can be folders, and there can be a lot of subfolders also inside these folders. Okay, but these in a like kind of uh, giving you an overview. These are the core documents or core things what we as an advisor or like we as a consultant reviews when we do a DD. Okay, so I'll move to the next slide. So again, so investor readiness, a continuous process. This is what I want to like kind of again stress a little bit more. So people see investor readiness as a one-time access, which absolutely is a wrong notion. So investor readiness is a continuous process. You should be like kind of this is I mean, once you raise the investment, it doesn't mean that you can stop being investor ready. It means that you should be like kind of following all these things again and again, You should be like kind of keeping everything updated, because there are chances that you may raise funds in the future, and even if you don't raise the funds in future, all these things are actually important for you. For some reason or the other reason, you would be requiring all these things. So treat readiness as a hygiene practice, not as a one-off event. Update financials, KPIs, and projections regularly. So you should be updating your financials, the key performance indicators and projections regularly. So when I say update the financials, so one year is completed, you will have to file the financials with the revenue authority. So that thing you have to update in the folder as and when it is done. When you file the GST returns, you need to upload it there. When you what you have MIS every month. So each month MIS you should be updating in the folder, so that your KPIs are tracked properly and like kind of monitored in a neat manner. Then also projections also you need to update. Why projections should be updated is because the market scenario what you were in when you were doing the projection would have completely changed in the current this one. So you need to like kind of make tweaks and changes in your projections to make it look more realistic and achievable. Okay. Then revisit your business plan and competitive landscape. So you need to like kind of uh, again have a glance into your business plan, like whether it is working or like and whether you need to do any tweak, whether is there any new competitor who have come into the market, or is there any competitor who have launched a new product which can be a like kind of a challenge for us. All those things we need to revisit. Then maintain organized documents and governance, again another important thing. Then iterate your narrative as the market shifts. This is very important because see, typically I've seen founders, I've worked with a lot of founders, the pitch that they give to the investor today would be entirely different from what they're going to give after 6 months. That is not because the founder has changed his mind or like kind of he has changed his business model. It's because there could be some shift in the market, or kind of there could be a trend in the market which is shifting towards another direction. So the narrative, the founder keeps on changing based on that. Okay, so that it's very important to iterate your narrative as the market shifts. So that this sort of flexibility and adaptiveness is something what typically investors would be looking for in founders. So what are the common pitfalls when we speak about investor readiness? First is the weak financial preparation. So incomplete models and messy statements signal poor capital management. So like kind of the projection is not neat, like kind of there are a lot of wrong assumptions. It's not like kind of clear. The investor is not able to understand what you're doing and all those things. Then unclear value proposition, failing to articulate why customers choose you undermines differentiation. So if you are in a very competitive landscape and you are not able to tell the investor why your product or like kind of why your uh, service is different from the other, and why the customers would choose you over any other, is something what you should be able to tell to the investor. So there should be like kind of a very clear value proposition for that, and you should be able to communicate that to the investor in a neat manner. Then weak team presentation, lacking relevant experience or commitment erodes investor confidence. So that's again another thing. So typically, like kind of investor looks for relevant experience. So when I say relevant experience, for example, if you're running a consulting business, he'll be looking for you to have some sort of a consulting based education background or some sort of a previous experience. If you are like kind of entirely different from that segment, for example, you are a pilot becoming a financial consultant, that's actually kind of a I mean wrong sort of this one for the investor. Then unrealistic projections, hockey-stick forecast with evidence damage credibility. So without evidence damage credibility. So like I've told earlier, so this year you are doing 100,000 in revenue. Next year it's going to be like kind of what 1 billion. So that's going to be very unrealistic. So this hockey stick for when I say hockey stick forecast, it's kind of a high jump like kind of thing. So those things without proper evidence. So if you have proper evidence backing those things, and the investor and you think that it is convincible to the investor, then it's well and good, no problem. But if you don't have proper evidence, and it's just purely out of your ambition or like kind of your uh, like kind of thrive that you're showing that numbers, means that's going to be a negative thing for the investor. Then chaotic data room, disorganized documentation signals operational chaos and kills deals. So if you have folder, like you have the in one folder you have the GST return, TDS return, and agreement. In another folder you have the financials and what the shop and establishment license. So if the data room is not organized, it's not in a proper manner, that again is going to be like kind of see the team who is doing the DD, or like kind of the investor, if their internal team is doing the DD, for them it's kind of a disorganization, not disorganized kind of thing, and they will tend to believe that these guys are not organized and these guys are not taking business seriously. So that's another common pitfall. So again, going through weak financial preparation, unclear value proposition, weak team presentation, unrealistic projections, chaotic data room. Okay, so I'll just move to the next slide now. So role of professional support. So where actually like kind of professionals like chartered accountants, or like kind of where I typically help my clients is something what I just want to like kind of tell you, because see the support from a professional is actually needed for being investor ready, unless and until like kind of you have a full-fledged finance team, or like kind of somebody in your team like kind of who is really capable or who have done these sort of deals in the past. Okay, so investors expect credible gap aligned financial supported by scalable systems. So maybe like kind of your accountant wouldn't be that experienced, so they will be accounting based on the cash, like kind of when your bank there is an entry in the bank statement, that is when you're recording the entry, which ideally should not be. So you should, there is an accrual basis of accounting. So your accountant may not be following that. So you'd be requiring professional support, or like kind of somebody to look into those things. I'm just telling basic examples. Then fractional CFO leadership provides forecasting, scenario planning, and investor communication without the cost of a full-time hire. So this is where actually fractional CFO is of real help to businesses, because in forecasting and like kind of doing scenario planning and all these things, and again like kind of investor communication, you actually would be requiring somebody who has got prior experience in working in such environment and in such deals. Because see the thing is like kind of there will be a lot of jargons which would be used in these sort of deals, and the investor would be wanting somebody who understands these things. And as a founder, if there is somebody who is capable enough to have these sort of communication with the investor and sort things for you, that's actually going to be a lot of time saver for you, and like it's that's going to be a definite value addition for you. And if there is somebody who can help you with forecasting your business in a very neat and like kind of with those minute details, that is again like kind of going to give you more clarity on how your business is going to be, and gives the investor the confidence that yes, these guys are professional. So that is again another thing what the investor would be doing. Then gaps in tax strategy, reporting, or controls can surface during diligence, showing slow deals and eroding valuation. So again, like kind of if your taxes are proper, like whether you are filing your taxes on time, whether you have missed out on TDS compliances, all these things, if you have the support of a fractional CFO or a chartered accountant, you would be able to like kind of understand. In most of the cases where I typically work with my clients, I've seen this lot of tedious issues, because I mean, the accountant misses to like kind of deduct TDS in most of the cases, or maybe like kind of the foreign payments. That is where typically people miss a lot of TDS payments. So these things, with the help of somebody like kind of who is a professional, who has got experience in working with startups and these sort of deals, would be really helpful for the business. And if your controls are like kind of in place, and like kind of your uh, compliances are proper, this can actually faster the deal also. Okay, and also like kind of when there is a lot of non-compliances, there can be a chance that the investor may negotiate too much on the valuation as well. Then bringing in experienced advisors signals discipline, self-awareness, and reduces execution risk. So this is what I mean. Everybody knows, like kind of when there is an experienced advisor coming in, they kind of try to bring in that sort of discipline into the company, and you will also be aware of like what is happening in your business, because typically like kind of most of the founders doesn't know like what is happening in their business. They don't have a proper MIS report. They don't have a proper financial. They don't have a P&L coming every month in their way. So all these things would be like kind of addressed there if you have a professional financial support. Then again, accelerate your fundraising. So typically, like kind of if you're investor ready, you can close your deals in 3 months. If you're not investor ready, it will take around 9 months. I mean, these are general median numbers. So if you're investor ready, typically due diligence is where typically it takes a lot of time. Whenever I do DD, we typically work for 10 to 12 working days to complete the entire DD process for a small stage startup. But this 10 to 12 days is actually spread across 2 or 3 months because the client is not able to provide me the data on time. So if there was a proper system with them, the DD would have been completed in like what, 2 weeks time. So ideally you would have saved around 2.5 months time just in the case of DD alone. So the overall fundraising journey would actually be less if you are investor ready. Then steps to become investor ready, build a strong foundation. You should be having a private limited company and all those things. Then assemble your team. Your team should be proper. Recruit credible leaders and advise with domain expertise and commitment. Validate market and traction. Gather evidence of demand. Define your unique value proposition and track KPIs. Prepare your financials. Like your financials should be gap compliant. It should be like kind of adhering to the accounting standards of that particular country you are in. Then the projection should be realistic, and also like kind of always aim for audit readiness. Then craft your narrative, tell a compelling story backed by data and organize your data room properly. Develop tax and controls, establish a proactive tax strategy, risk management and basic controls. Engage professionals, leverage fractional CFOs and advisors, knowledge gaps. Then practice continuous hygiene. Regularly update materials, revisit your plan, maintain governance and communication. So these things I have explained in the previous slide also. So I'll move to the next slide. So again, like investor readiness hygiene. So keep your, again, these are all repetition. Keep financial statements up to date and compliant with accounting policies. You should be keeping board. You should be conducting regular board meetings, and you should be documenting all the minutes. There are a lot of statutory registers and statutory documents which the registrar of companies or minister of corporate affairs mandates you to keep. So all those things you should be updating properly, and like you should have all these things uh, kept in a folder in an organized manner. Maintain your cap table and legal documents. So your cap table should be regularly updated when you have some investor or somebody coming in, or there is a share transfer or anything happening. Based on this, your cap table should be updated, and all the legal documents pertaining to your investment should be kept properly. Monitor KPIs and industry trends. So you should be like kind of monitoring your own KPI, compare it with like kind of your competitors and how you are doing well in the business, and like kind of what are the current industry trends, and do a comparison, and like kind of all those things you should do. Then practice technology hygiene and data security. That's with tech companies like your, for example, if you are using some, how I would say, for example, there is no proper security system within your company. Like anyone from outside can access your data. That's going to be a serious concern for the investor, and that's actually going to be a very big red flag. Then conduct periodic internal due diligence. So when you have a fractional CFO or somebody like a third-party advisor, if you can conduct periodic internal due diligence, you will be able to identify the gaps or lapses in your business before an investor identifies that. Okay, so what happens is like kind of you'll be more prepared. You can correct the mistakes well on time, and what happens like uh, everything would be updated properly, and like kind of you will not spend a lot of time for the DD when it actually happens by the investor, or when the investor actually appoints somebody to do the DD. Then communicate regularly with investors and stakeholders. So there should be a proper investor and shareholder communication, like monthly or quarterly. You should be sending the reports and the key numbers. Try to take meetings with them, explain like kind of how the business is progressing, and all those things. Refresh your market analysis and business plan. This I have already told. When the market is shifting, or like kind of there is a lot of change happening in the business, you should like kind of refresh your market analysis and change the business plan accordingly. Then benefits of being investor ready: stronger performance, transparent reporting, sound governance, and strategic clarity drive operational excellence. So you'll be able to like kind of do your business in a much more organized manner, and like kind of knowing your limits and strength. That's very much important for any business. So you'll be able to perform better. Then higher valuations, credible numbers, and clear growth narratives command better terms. So if everything is proper, you have proper numbers, and you have so much clarity, that's going to actually help you in the negotiation part a lot. You'll be getting better valuation from the investor. Then faster fundraise, I've already told. Prepared companies respond quickly, close rounds sooner, and reduce uncertainty. Opportunity readiness, be ready for unexpected offers or transitions without scrambling. So that's again like what I've told already. So you will be able to like kind of crack unexpected deals when you are ready. Risk mitigation, proactive governance and controls prevent deal killing surprises. So if you are having internal DD, or like if you are having internal verification of your company's records and everything, you will be identifying any threat or any issue with your governance or compliance before an investor or a third party DD team finds it out. So those things actually can be deal killing. Like the investor may not proceed with the deal if there is something like that in the company. So if you identify it earlier, you can mitigate those things. You can do corrective measures, and so that the deal would go through. Yeah, so key takeaways: investor readiness means being prepared to credibly engage investors through a solid foundation, a strong team, market validation, robust finance, and compelling narrative. DD is comprehensive, assemble a professional data room covering financial, legal, contractual, equity, IP, team, strategy, and all those documents. Readiness is a continuous hygiene practice. Regularly update financials, governance, and market insights. Engage professional support early. Fractional CFOs and advisors provide strategic insight and credibility. Treat finance as a strategic asset to accelerate fundraising and protect valuation. So that's actually going to be an important asset for you, because finance is a key pillar of your business. And if your finance is proper and like kind of everything is up to date and everything is compliant, that will actually help you to raise funds faster, and also it will protect your valuation as well. Yes, so that's it. So now we can have the Q&A session. So also like I've kept two QR there. One is for joining our WhatsApp group where we typically put in updates about the seminars, and the other one is my LinkedIn. This one, if you want to connect with me or like want to chat with me on something, like you can connect with me on LinkedIn. Yeah. So if anybody have any question, you can ask now.
Hello.
Yeah. Hi there.
Hello.
Yeah. Hi there.
Hello.
Yeah. Hello there. I can hear you.
Hey, am I audible?
Yes, you're audible. You're audible.
Hi, Abhijit, myself, Dave. Actually, the thing is, where exactly do you find the right investor? Like, what is the process? What is the exact process? Because on LinkedIn, you find multiple people who claim to be investor, but I have found like many of them are just fake, maintain the fake profile or something like that. And if we go to an institution, they ask for, I would say, many things like traction and growth. And currently, I'm in early stage right now.
So are you in a pre-revenue stage now?
Yeah, right now in the development stage, we are in pre-revenue, but we are about to launch on 8th of March probably.
Okay.
And I just want to prepare myself for investment so that like when the time comes, I have funds in my account.
Okay. See, I understand your point. This is typically like what I tell everyone. Like, see, at a very early stage, at a pre-revenue stage, it's actually very difficult to raise funds from an outside investor, because what is actually revenue? Revenue is not just money coming into your business. It's also like customer approving that your product or service is actually worth the money. Like they're ready to pay for your this one. So that actually validates that what you're building or like what you're providing is something worth, or like something which actually is worth it. So at early stage, it's actually difficult to raise funds, and where you can find investors is typically like see, with all these ChatGPT, Gemini, and all. If you do a deep research on the specific sector in which you are operating, that is better thing. Like typically like for deal hunting and all, what I use is there is a tool called Traction which you can rely on, but I think it's a paid tool. You'll have to take the subscription or anything. But apart from that, with the deep research facility of ChatGPT and Gemini, if you prompt properly what segment you are in, what is the typical scale of investment that you're looking in, and help me find investors who have put in this space, and who are sector agnostic and all those things. No, you will get a list of investors who generally like I mean put at this point of view, and those are supposed to be genuine also.
So cold contacting the investor is the right path because it seems like I'll have to contact hundreds of investors if I go in the
That's
cold way.
how most of the people, like 99% of the startups, raise fund in that way. There is no
Okay.
shortcut for that. Else,
Got
like,
it.
your business should be that really good, and like, you should be having some sort of a PR value or something. Like you are like what you have been your article or something, or your business has been published on some media or something, and like everybody is amazed by what you have built. In that case, maybe like an investor may come and approach you. Apart from that, I don't think like there is a strategy. Or maybe like see, another way to outreach to investor is ask for a reference from your friends who have raised in the past. So that is another way you can approach investors.
Where I understand, like reaching out investor can be difficult. So what about the hiring a catalyst or investment banker?
See, that's typically good. That's how typically most of the clients do, and that is what typically an investment banker also does. So they help you with organizing all these things in a proper manner, and also help you with the outreach process as well. And I would say, like, this raising investment from VCs or investors is more kind of a probability or a power kind of game. The more you reach out, the more chance you have of closing your funding.
All right. Thank you so much, Abhijit.
Yeah. Yeah, Rohit, you can ask your question.
Hi, great presentation. Thank you very much.
Yeah, thank you.
Do you have any ideas as to what kinds of software companies need as they build up? So an MIS software as an example, I wouldn't even know where to look.
So, I mean, see, typically depends on the segment you are operating in, Rohit. So, even if it's a software, also like the customer number is a like very relevant KPI. Maybe like if you are in the B2B space, what is the number of customers? Or even if you are in the B2C space, what is the customer base? What is your ARPU, like average revenue per user or average revenue per unit? How that has been going over the year? What is your MRR and ARR, or your recurring revenue? I mean, the predictable revenue, how much it is, like how it has been increasing month on month. All those things are relevant KPIs for a software company.
Okay, but is this the kind of thing that Zoho does, or I'd have to look further afield?
I mean, see, with Soho, typically, like you would be able to get numbers of your financials and all those things, like what's your revenue, what's your profitability, what's your expenses and everything. But on top of that, we should be having an operational MIS as well. For example, the number of customers you have, and all those things typically comes from the back end of your software, or like the report which is being generated from your software. So those things, it's better to maintain separately. Financials numbers you can pull out from Zoho.
Okay.
Yeah.
Thank you.
Thank you, Rohit. Yeah. Does anyone else have any question or?
I've just got one observation, Abhijit, if I can share that.
Yeah.
I think it's quite interesting where we've seen a couple of deals in the market where, these maybe medium to large size companies, they have some auditor, which seems to live above a shop in a, tier 3 city. And, for me, that's a red flag from the very start. If you're a medium sized business, why would you not have maybe a top 10 accountant and so forth? So do you agree with all of that? I mean, whether you're an investor looking at a company or vice versa, would you say, have the most expensive advice that you can afford, or the best advice that you can afford?
I mean, see, if you ask me, like, see, that's actually kind of a subjective answer. If you ask me, see, the thing is, it doesn't matter unless and until like your advisor is not helping you, or like they don't have the relevant knowledge. If be it a tier 3 city advisor or a, see, if you look at most of the audited financials of all the startups who have raised fund, their chartered accountant or their auditor may or may not be from tier 1 cities or tier, like I've seen like a lot of startups who have raised fund also from like the audit firm could be from a tier 3 place. Like the auditor could be somebody whom they know in their hometown and all those things. But that doesn't really affect the funding as long as your fundamentals are right and like strong. And if the investor asks for your auditor or your advisor to be in the call and explain things, and if they are not aware or like not able to speak the language or speak the manner in which the investor expects to do, that can be a red flag. So it's important to have people who understand the business as your advisor or auditor or whoever it is. That's more important, is what I feel. Because see, I don't think most of the early stage startups or early stage companies or even SMEs would be able to afford top 10 accounting firms in India. They're this the charges that they have is quite high for any of those companies to afford.
Okay. Okay. Thank you. Thank you.
Thank you, Rohit. Yeah. Yeah. So if you don't have any more questions, I'll wind up the session then.
Sorry, can you hear me?
Yeah, Govind, tell me.
Yeah. The thing is that actually we have started our company in the year of 2016. But if you check
Your
out,
voice is not clear. Like there is some sort of, I mean, hello.
is it okay now?
Yeah, it's better now. It's better now.
Yeah, actually, we started our company in the year of 2016.
Mhm.
Almost we are just nearing 10th year. But the thing in between, we tried a product, we just failed in that attempt, and we just revamped everything. So last year we have generated the revenue of say some 48 lakhs, and this year we are going to close around 3 crores. So last year traction was there, and the product has been validated by the market. If we start raising funding, is there any question will come? Why we have taken 10 years like that, or it is not the concern for the people who just invest money? Just to understand.
I mean, see, that can be a question, but if you have proper answer, like
Okay.
maybe you have done the right pivot in the last year.
Okay. Yes.
So that's when
Okay.
we started. See, investors typically would appreciate or would love people who take pivots for the
Okay.
betterment of business, and that is showing results. Means that investor would definitely be appreciating you, and that instills a lot of trust in you. So tomorrow also, like if there is some sort of market condition going bad and your product not doing in a good way,
Okay.
then you will be flexible enough to do in the next pivot.
Okay. So in that case, actually, I just I listened all your presentation, and we are just doing all these things. We are in the preparation level, but we don't have any experts to support us. We
Hmm.
know that we just chit chat, and we just got it from ChatGPT and other things. We just understood what are all the documents to be prepared, and we are doing that. So, do you recommend to just hire or just get a support from an expert to do that, or the way we are just doing, we can just manage later on, we can just do it in a different way? How do you
I
recommend
mean,
us?
if you're serious about raising funds, definitely you should be getting a professional support. That will actually
Okay,
make your life a lot easier.
okay,
And there should be typically like I've told, I do a lot of DD and I do
great.
a lot of investment readiness exercise. So whenever I
Okay,
do DD, I love to or I would try to speak with the finance person, or if they have somebody as a CFO or a
okay,
virtual CFO, I try to speak with them because uh, a lot of I mean they understand the business in much more in the number angle and all those things, and they would be able to give us the data in a much more speeder manner. So we typically try to
okay.
speak with the finance people mostly. So it's
So
better.
to actually, if you recommend either CFO, that virtual CFO, or like that, what is the role which we have to expect to just onboard them as a supporting, like in that investment banker or any that virtual CFO, who you just recommend to just onboard to just support all these activities, Abhishek?
So I mean, see, typically the investor bankers would be mostly helping me with the outreach process, I would say, uh,
Okay, so they are
and
not the right thing. Okay,
specific to a fundraising plan. But a
okay,
CFO is something who stays in your business for a longer time,
okay,
irrespective of whether you are raising the funds or not. So
okay,
fundraising just becomes one activity in the CFO's journey.
okay.
But investment banker is somebody who typically comes in when you're raising an investment only.
Okay.
That's the difference.
So, shall I understand you just recommend us to go with a CFO kind of resource where
So I would
he
recommend you to go with a CFO kind of person now.
great, great.
And
Thank
that
you,
was
thank,
recommending you with
thanks,
investment banker and everything.
thanks, Abhijit.
Yeah.
Thank you, thank you.
Thank you, Govind. Yeah, so guys, so thank you for being in the session and staying active and asking all the questions. So we'll see you after a couple of weeks. Okay. Thank you, everyone. Bye. Have a nice day. Good night.